How does GDP growth affect the GBP USD rate? Have you ever wondered how the growth of a country's economy can influence the value of its currency? Let's take a closer look at how gross domestic product growth impacts the GBP USD exchange rate. When the economy of the United Kingdom grows, it usually indicates a healthy and expanding market. This growth often attracts foreign investment, which increases demand for the British pound. Investors need British pounds to buy assets in the UK, and this demand can push the value of the pound higher compared to the US dollar. On the flip side, if the economy of the United States is growing at a faster rate than that of the UK, the US dollar may strengthen against the pound. This dynamic is a natural part of capitalism, where market forces seek the best returns. When the UK's GDP growth outpaces that of the US, it suggests better business opportunities and higher corporate profits, which can attract even more global capital. This influx of investment helps strengthen the pound as demand rises. Another important factor is how GDP growth affects interest rates set by central banks. When the economy grows strongly, inflation can increase due to higher consumer spending. To manage inflation, the Bank of England may decide to raise interest rates. Higher interest rates can make British assets more appealing to investors, leading to more foreign capital entering the UK. This can further support the pound's value against the dollar. However, GDP growth is not the only factor that influences the exchange rate. Other economic elements, such as inflation rates, trade balances, and political events also play a role. For instance, if the UK has a trade surplus, it can lead to increased demand for the pound. Conversely, political uncertainties like those surrounding Brexit can create volatility and impact investor confidence. For businesses involved in international trade, understanding GDP growth trends is essential for anticipating currency movements. A rising GBP USD exchange rate due to strong UK GDP growth can make British exports more expensive for American buyers. At the same time, it can enhance the purchasing power of UK importers. Investors and multinational companies keep a close watch on these trends to make informed decisions about currency exposure and investment returns. In essence, GDP growth significantly affects the GBP USD exchange rate by signaling economic strength, influencing capital flows, and shaping monetary policy. In a global capitalist market, these factors reflected how resources are allocated toward economies with higher growth potential, driving the movements of the British pound against the US dollar.